welcome. You're here, I imagine, because you want to grasp things quickly, get those aha moments, but, without drowning in information.
Exactly. And today we're tackling something really, really fundamental.
Absolutely. We're diving deep into understanding the crucial difference between investing and speculating.
And this distinction, well, it's not new. Benjamin Graham hammered it home in The Intelligent Investor, but you see it echoed everywhere, really. It's key for long-term financial security.
It really is. And we've got some great material to draw on today. We've looked at analyses of Graham's book, some articles that break it down for beginners, which is great.
Hmm.
There's a pretty interesting Reddit discussion, too, showing different takes, definitions from Investopedia, even stuff on teaching kids about money.
Right, and pieces on Buffett's thinking, a basic YouTube explainer, a good mix.
Definitely. So our mission today, simple, really. Give you a clear, solid understanding of investing versus speculating.
Yeah, so you can approach your finances with, well, more clarity, more confidence, less guesswork.
Okay, let's jump in. What is investing, fundamentally?
Well, if you go back to Graham, he had a pretty strict definition.
Right. He said it demands thorough analysis, first off.
Exactly, thorough analysis. And that analysis has to promise two things. One, safety of your principal, your initial money.
That makes sense. Safety's first.
And two, an adequate return. Not necessarily a huge return, but an adequate one.
And if it doesn't meet those criteria,
Yeah.
through analysis.
Then Graham says it's speculation. Simple as that.
Okay. So analysis, safety, adequate return. That's the core.
That's the core of investing. And you see this echoed, like Atish Laliankar explains it as buying something, hoping it'll generate income or grow in value, appreciation.
So it's about building security over time, not just like hitting the jackpot.
Precisely. It's not gambling. It's a plan for long-term financial health.
Investopedia aligns with that too, doesn't it? Allocating funds to assets, stocks, bonds, whatever.
Mm-hmm. Expecting income or profit, usually through price appreciation.
And crucially, they mention lower risk for satisfactory returns. That feels, well, manageable.
Yeah, it's meant to be. Think of it like planting an orchard rather than playing the lottery. You research the soil, the trees, you tend them, you expect fruit over time.
Okay, good analogy. So that's investing. Now let's look at the other side, speculation.
Right. Graham acknowledged, there's probably always some speculation when you buy stocks.
But he warned against letting it dominate, didn't he?
He did. He said, keep it minor, use separate funds, almost like an entertainment budget, and be ready for things to go wrong.
Yeah, he said it can be fun if you're winning, but don't confuse it with your serious money.
And Buffett, looking at Graham, really emphasized that speculation is fundamentally about trying to predict the future, which is, well, incredibly hard.
Laliankar points out the danger, too. He calls speculation a transaction with a large risk of losing your money, even if there's a hope of a big gain.
Yeah, he stresses it's often based on, like, hunches or market noise, not real research.
And he warns it can be addictive. Treating it like investing is a big mistake.
Definitely. Investopedia frames it similarly. High probability of failure, seeking abnormally high returns from high-risk bets, often short-term holding.
That short-term aspect seems key. It's not about owning a piece of a business for the long haul.
No, it's often about predicting short-term price swings. Day trading, swing trading, that kind of thing.
What about the Reddit discussion? That brought up the gambling comparison, right?
It did. Some people see parallels because both involve risk. But, a key distinction that came up was the basis for the decision.
The analysis part again. Investing, even if it goes wrong, usually starts with some thought, some reason.
Right. Whereas pure gambling often lacks that foundation. So let's crystallize these differences.
Okay, first up, risk level. Seems obvious, but important.
Absolutely. Investopedia draws a clear line. Investing aims for average or below average risk. Speculation, significantly higher, much higher.
Like you said, established company versus, I don't know, a meme stock might be.
Could be, yeah. Then there's the analysis piece. We keep coming back to it.
Because Graham and Investopedia both say it's central to investing. Thorough research.
Whereas speculation, according to Laliankar and Investopedia, often relies on gut feelings, tips, maybe market sentiment, not deep dives.
Okay, risk, analysis, what else? Time horizon.
Big one. Investing is typically long-term. Investopedia suggests holding for at least a year, often, much longer.
In speculation.
Short-term, days, weeks, maybe months, trying to catch quick moves.
Got it. And the expected return follows from that, I get.
It does. Investing aims for adequate, satisfactory returns over that longer period. Sustainable growth.
Speculation chases the big, fast profits, the
Okay.
home runs.
Exactly. Which inherently comes with that higher risk of striking out completely.
Another point, what you actually own when you invest in a stock.
You own a piece of the company, a real share in its future. Investopedia in the YouTube video mentioned this. You might get dividends, a share of the profits.
Right. Whereas gambling, you're just betting on an outcome, no ownership involved.
It's a fundamental difference. And related to that are the odds over the long haul.
The stock market tends to go up, right? Positive expected return as businesses generally grow. That came up on Reddit in Investopedia.
Generally, yes. It's considered a positive sum game over time. Gambling. It's structured so the house wins. Negative expected return.
Okay. And what if things go south? How do investors handle losses compared to speculators or gamblers?
Investors have strategies. Investopedia mentions diversification. Don't put all your eggs in one basket.
And things like stop-loss orders to limit downside on one specific investment.
Exactly. Gamblers, fewer safety nets. Often it's just, well, lose the bet.
And information seems different, too.
Yeah, Investopedia points out there's usually a lot more reliable information available for investment decisions, financial reports, industry data.
Less so for pure speculation or short-term bets, maybe.
Often, yes. The information might be less transparent or more focused on just sentiment.
Now, Loliankar mentioned intelligent speculation. Is that like a contradiction?
Well, not entirely. He argues it can exist, but only if you're fully aware of the high risks involved.
So, knowing it is speculation, not pretending it's investing.
Exactly. And keeping it separate, using funds you can absolutely afford to lose, it becomes unintelligent when you fool yourself or risk too much.
Graham kind of said the same, right? Recognizing the risks is key.
Absolutely. It has to be a conscious choice, accepting those risks.
This kind of leads into Graham's idea about different types of investors, doesn't it? Defensive versus aggressive.
It does. The defensive investor, as analyses of Graham show, is all about safety first. Major companies, long track records of profit, strong financials.
They're not trying to beat the market necessarily.
No, they're often skeptical about that. They might just go for simple diversification, maybe 50-50 stocks and bonds, and they definitely avoid the hot new things.
Okay, safety and simplicity. What about the aggressive or enterprising investor?
They are trying for better than average results, but Graham insisted it has to be based on sound, often unpopular strategies.
Like, what, finding bargains the market missed?
Exactly. Undervalued stocks may be due to temporary problems or just market neglect, or finding companies selling for less than their basic asset value. It takes more work.
More research, more time, maybe a thicker skin to go against the crowd.
Definitely. So thinking about where you might fit on that spectrum, defensive, enterprising, or somewhere in between that's useful for you, the listener.
And Buffett seems to land firmly on the side of Graham's core principles here.
Oh, absolutely. The Forbes piece highlights how he constantly echoes Graham. Investing is buying a good business at a fair price, ideally with that margin of safety.
Buying below its real worth.
Right. And speculation, that's just trying to guess market direction, which Buffett thinks is mostly futile.
He also mentioned liquidity being a potential trap. Just because you can trade a stock easily.
Doesn't mean its current price is right. Focus on the business value, not the daily ticker, was Graham's point, echoed by Buffett.
It's interesting how these fundamental ideas pop up even when talking about teaching kids about money.
It really is. The Security National Bank article mentioned things like the Money Bunny books or Berenstain Bears for the very basics. Earning, saving.
And then stepping stones like investing for kids to introduce those next concepts.
Yeah, and making it tangible, like the Prisma example of a lemonade stand connecting money to effort.
Grobian also mentioned talking about wants versus needs, setting savings goals, basic but crucial building blocks.
And that YouTube example, even investing a tiny amount like $1 a day shows the power of starting early and compounding. It underlines that these aren't just, Wall Street concepts, they're life skills.
That's right. Back to that Reddit discussion point about positive sum versus negative sum.
The idea that the overall stock market, because businesses create value, tends to grow the pie over time, positive sum.
Whereas a casino game is negative sum, the players as a group lose money to the house.
Exactly. Now, some Redditors argued the market isn't always positive sum because companies fail, there are fees.
Sure, caveats exist.
But the long-term trend, as Investopedia also notes, favors a positive expected return for the market, unlike gambling.
And finally, the danger of getting these two mixed up. It's not just theoretical, is it?
Not at all. That guru-focused commentary recalling Jim Cramer pushing internet stocks in 2000, ignoring value principles just before the crash.
Ouch, that cost people dearly.
It did. It's a stark reminder of why Graham was so insistent on this distinction. Getting caught in speculative bubbles thinking you're investing can be ruinous.
Okay, so let's try and wrap this up. Key takeaways.
Investing. Grounded in analysis, aiming for long-term growth, managing risk, owning something real.
Speculation. Higher risk, often shorter term, focused on predicting price moves, not necessarily underlying value.
And Graham's definition is the touchstone, isn't it? Analysis, safety of principle, adequate return, that's an investment operation.
Everything else, speculation.
Pretty much, and knowing that difference really empowers you.
Yeah, it helps you make decisions aligned with building real long-term security rather than, getting swept up in market noise or hype.
Moves you away from that unpredictable side, the speculation that sometimes masquerades as investing.
So, maybe a final thought for everyone listening.
Yeah.
Take a moment and consider your own approach. Are your financial decisions driven by that careful analysis and long-term view?
Or are they leaning more towards the excitement, the uncertainty, maybe the hope of a quick win that characterizes speculation?
Reflect on how applying these principles, analysis, safety, long-term perspective, might shift your strategy. Maybe for the better.
And definitely keep exploring. Look into value investing, financial literacy resources. It's an ongoing journey, but one that can really pay off for your financial future.